Hi everyone, this is Daniel with Ananti, and today let's look at the components that make up your monthly mortgage payment. As we know, whenever you send your monthly payment to the bank, it has different factors or components that make up the entire amount. The entire amount do not, as some people get it confused, does not reduce the loan balance. So any monthly payment will usually have this component. So we have the principal, we have the interest, we have the property tax, and then we have the homeowners insurance, and then we have the PMI. In most cases, PMI may not be applicable if you pay down 20% or more towards your down payment. But if you pay down less than that, this amount or this component will be there. It's worth noting that it is only the principal component that's actually buying your house. The rest are just costs for having the mortgage, and the other aspect, that is the property tax and homeowners insurance, will be there for the entire duration of you having a home. Now, the principal component of your monthly mortgage payment is the part of the loan that you repay. And this is what reduces the loan balance every month. And this also helps you to build home equity so that in case in the future you want to sell the house, the amount that you actually have in the house that belongs to you, that you've paid down, you may be able to cash that amount or have that amount as profit. And that's what they mean by equity. And then this component is always included when you make the monthly payment, and it doesn't go away until the mortgage is paid off. The interest component is the cost of borrowing the money from the lender or the bank, right? It's paid to the lender. This money goes into the pocket of the lender. Of course, no one has 500,000 lying around to go buy a home. If you do, kudos to you. This is the profit that goes to the lender for lending you that money. You have to pay them something. And the unfortunate part is the lender wants to be paid first before you actually get to own your home. So at the beginning of your loan, the interest component is usually higher. So on a 30-year mortgage loan, you have the interest component taking a whole chunk of your monthly payment. Also, the interest that is charged on monthly basis is based on the loan balance. Now, if your loan balance, of course, with every loan term, the loan balance is usually high in the beginning of the loan. So once you're paying the loan down, the balance reduces, and so is the interest component as well. And this is also included until the mortgage is actually paid off. Then we have property taxes. Now, the property tax is going to be forever, so far as you own a home, right? So these are taxes collected. These are taxes collected for local services within your county or your state. And this is paid to the local government and usually collected in escrow. If you pay property tax directly to your lender, and it's always included. No one is escaping this for life until you sell your home. And even if you rent, that amount is always included with your rent. The property tax is not the lender's money. They collect it and forward it to your town. And it can rise over the years whilst you own the property. So if you're new or you're aspiring to get a home or a mortgage, you need to factor this in as well. The next one is homeowners insurance. Now, this protects your home and yourself as well. It covers damage and losses. This aspect is always included in your monthly payment. Now, there may be those that do not pay the homeowners insurance directly to the lender. They send it directly to the insurance company. So this is another component that after you finish paying off the mortgage, maybe some people do decide not to have an insurance. It blows my mind. But if you have such an investment or an asset, it's worth protecting, and that's where the insurance kicks in. So it's always going to be there with the property tax. Now, PMI stands for private mortgage insurance. It's worth noting that this particular component of your monthly payment protects the lender. It's required when you put down less than 20% towards your down payment, right? So anything, if you pay 3%, 5%, this component will be there. Okay, so and this is pure insurance for the lender to collect, right? This is extra money. Okay. Now the homeowners insurance protects you, but the PMI protects the lender because it's a risk, right? So you putting down 3%, that means you do not have enough equity, right? So the insurance kicks in and protects their asset, or it serves as a collateral for them. As I mentioned, it's required with low down payment and can be removed. Once you hit the 20% equity in your home, this component, that's the PMI, can be removed. One, by doing two things actually. So if the value of your home increases, that's equity that you didn't necessarily have to pay down your loan for. It's just the value of the home, and you have to do an assessment with the lender for them to confirm that yes, indeed, you have more equity now. Or you apply extra payments to reduce the loan balance so that you get to that 20% equity threshold. So this is removable at some point. So new homeowners or people aspiring to have mortgages in the future, just beware of this. Okay, now let's move on. There are those instances where someone may have 20% down payment, right? When they have 20% down payment, they may negotiate with the lender that they would want to pay their insurance and property tax by themselves. The lender may agree, the lender may decide not to agree or may refuse. For example, in my case, I do not pay my lender insurance and property tax. I pay them directly to the state and the insurance company. So in that instance, what happens is on a monthly basis, the homeowner will send these two components of the mortgage directly to the lender, excluding the property tax and insurance. This responsibility is just on them. They only send these two components to the lender. Now, on the other side, homeowners insurance and property tax, they will pay directly to the state and the insurance company. In my case, because I'm still paying this, I put an amount on the side to cater for this component of the monthly payment. Homeowners insurance, I pay it once a year, right? So once a year. And for property tax, I paid 4 times, right? 4 times a year, right? So every quarter, I need to make a payment. So what I do is I put all these funds in a high yield savings account. And then I have set multiple reminders because you do not want to be late on this payment. So I pay this directly to the insurance company. And then every quarter, by the time the quarter is up, I would have the funds available. And then I pay to the state. Now, the only benefit you actually get is because the money is not in escrow, you get to earn some interest on the money sitting in your high yield savings account. It's not much, but it's still some money. And that's the only aspect of you paying your own or managing your own property tax and homeowners insurance. And then the other part too is you will never owe, right? So because you get to see the bill directly, you get to pay the full amount. So at the end of the year or the following year, no one is gonna come back to you and say, "Hey, your monthly payment has gone up." So this is very critical. And also, even those people that send funds to their lender, they can look at these bills directly at the insurance company and also their state, right? So if you do not want to owe in the future, look at these bills and make sure that your escrow has enough every year to cover for the insurance and property tax. Now, this is an example of a typical payment that goes out on a monthly basis. And as you can see, it has components to it. So on a monthly payment that has 2,885.98 cents, at the beginning of the loan, only 14%, it could be less as well, only 14% is going to the principal. This component is actually reducing the balance of the loan. And then as we discussed earlier, this component, that's the interest, takes the bulk of the funds that you send to your lender, right? You can say 61% assumed on a loan amount of 378,000, right? So this is based on a 378,000 monthly payment. So on this amount, this is the component that goes towards the interest. So for you to pay less interest, that means that so far as the loan balance is reducing, the interest would also be reducing. And you can have a glimpse of this on your amortization schedule. And we have 14% also going towards the property tax. And then homeowners insurance has about 5%. And then the PMI is around 160. Now, PMI, again, you can remove this aspect once you have 20%. But for property tax and homeowners insurance, this is for life. Property tax also increases over time, and so does homeowners insurance. So every year you need to be assessing and making sure that you have enough funds to cover this component. So that's it. Now you know all the components that make up your monthly mortgage payment, right? So the principal, the interest, the property tax, and homeowners insurance, and in some cases, the PMI. At the start, almost none of your payment is yours, unfortunately. But over time, once you pay down the balance, you get to build some equity and also get ahead of the game by paying extra towards the principal to own your home sooner than later. When you add extra payments to the principal, you get to save in future interest charges. This is Daniel with Ananti. Thank you for watching. Catch you in the next one.